So you want to be a TFSA millionaire. Well, in this video, I'll break down 2 realistic strategies on how you can get to that $1 million TFSA. Then I'll go over 5 options on which investments you can choose to reach that $1 million goal. Lastly, I'll go over 3 tips on how to withdraw that $1 million to maximize your tax savings in retirement. But first, let's dive into 2 big mistakes to avoid if you want to reach that $1 million goal. The first big mistake, investing in only a savings account. Let's say that you have $95,000 today in your TFSA account and you contribute $7,000 each year into it and it earns a low interest at 2%. How long do you think this will take for you to get to $1 million? Well, the answer is that it will take you a whopping 56 years to reach that $1 million mark. And you'll have contributed a total of $487,000. Why this is a bad option is pretty obvious. It'll take you way too long to reach your goal of $1 million and it will cost too much. 56 years is insane. If you start the strategy at age 25, you'll be 81 by the time you get to $1 million. But I know for a fact that a lot of Canadians are using this method though. A recent BMO survey shows that 47% of Canadian TFSA holders have only cash and savings in their accounts. This sadly means that for many Canadians, they'll likely never reach that $1 million goal, even if they max out their TFSAs every year. Big mistake number 2 that I see a lot, taking on way too much risk. On the opposite end of the spectrum, we have a crypto investor who takes insane risks and bets on very high-risk crypto coins. Assuming that he has $95,000 to invest and he doubles his money for a 100% return every year, it will take this investor between 3 to 4 years to reach the $1 million mark. And he will have only invested a total of $120,000. 3 to 4 years sounds amazing, you might think, but this is a terrible strategy as well. And I'll tell you why. Yes, this person might have gotten lucky and hit that $1 million within 4 years, but the vast majority of people who try this high-risk, high-reward strategy will not have such generous returns. In fact, the chances of going to zero are extremely high, and that makes this entire strategy worthless for most people. Because if you go to zero, you have no chance of hitting that $1 million at all. But cruising through the subreddit Wall Street Bets, I know this is a strategy that many people employ as well. Warren Buffett's famous quote, "Rule number 1, never lose money. Rule number 2, never forget rule number 1, emphasizes the importance of avoiding losses rather than striving for spectacular gains in investments. Alright, so now you've seen 2 very opposite ways to reach a $1 million TFSA. Now let's go over the ways that I think you can actually earn $1 million in a sustainable manner and in a more reasonable time period. Balancing your risk and return. Think of investing like choosing a driving route. The highway might get you there faster, but if you're driving way over the speed limit, there are higher risks like high-speed accidents or speeding tickets. A slower back road can be safer, but takes longer. Similarly, in investing, higher returns often come with higher risks, while safer investments give you steadier but lower returns. You've now seen 2 examples on how to get to $1 million TFSA. One is a very low risk and low return method, which would take way too long to reach your goal. And the other was an extremely high risk, high reward method that has a high chance of losing all your money. The key is to find a middle ground. You'll first need to figure out your risk tolerance. You can start by filling out a free online questionnaire, such as this one here provided, which I've linked to below. Then it's simply a matter of picking out the right investments that can get you to that goal in a reasonable amount of time and contributing to your TFSA regularly. Alright, so let's go through another realistic example here, investing 100% in equities. Say you have a high risk tolerance and want to invest in 100% stocks or equities. Taking a look at the previous 20-year returns for the Canadian stock market, it shows a return of 7.8% per year. Now let's assume a smaller number at 7% for our example. Let's say you start with $95,000 and you contribute another $7,000 each year going forward. You'll be invested in 100% equities for an average return of 7%. Now it will only take you 25 years to get to that $1 million mark, and you'll have invested only $270,000. You can start the strategy at age 40 and reach your goal by retirement age of 65. Alright, going to another example here. Now let's say you have a medium risk tolerance and you want to invest in 50% equities and 50% bonds. Looking at the previous 20-year return for bonds of about 2 to 3% per year, let's make an assumption if you combine these bonds with equities, you'll earn a return of 4.5% per year. Well now, if you start with $95,000 and contribute $7,000 each year into your TFSA and invest at this 4.5% rate, it will take you about 35 years to reach your goal. and you'll have contributed a total of $340,000. You'll have to start at age 30 for this strategy to reach the $1 million goal by retirement age of 65. And I think many Canadians will fall into this category, but the best part is that it's a medium risk strategy and that can be attainable by most people. So now you've seen 4 very different ways to get you to $1 million TFSA. As you can see, how long it will take you will depend on your risk and return. It's best to find the sweet spot of not being too risky as to risk losing all or most of your money, but still have enough return to reach your goal quickly, as in the last 2 examples here. Next, let's go over what you should invest in to achieve your $1 million goal. But first, like and subscribe to the channel if you like what you've heard so far. Okay, so what should you actually invest in your TFSA? I'll go through 5 options. The first is avoiding mutual funds at a big bank. Now, I know it's super tempting. Big banks are everywhere. They're convenient, and setting up an investment sounds as easy as ordering coffee. You just walk into a branch, chat with an advisor, answer a few questions, and voila, you're set up with a mutual fund. But here's a catch. These funds often come with really high fees. We're talking about some of the highest in the world. The fees can top 3% for certain funds per year. And that's a huge chunk of your investment gains gone just like that, which is why I don't recommend going this route. Now let's shift gears to ETFs, or exchange traded funds. These are a fantastic choice if you're looking to keep costs down. ETFs basically mirror the performance of a market index. So you're essentially earning close to the market that you invest in. Vanguard and iShares are 2 popular providers in Canada that I like and have very low fees. However, while ETFs are cost effective, they still expose you to market volatility, and you'll need some basic know-how on trading since they're bought and sold on stock exchanges. Investing in individual stocks gives you ultimate control over your investments and with the lowest fees involved. You can choose exactly which companies to invest in and when. A dividend stock strategy not only provides the potential for capital appreciation, but also pays out a portion of the company's earnings regularly, giving you a steady income. They can be a fantastic way to build wealth over time. However, it requires a good deal of market knowledge, and you'll need to dedicate time to manage your portfolio effectively. Remember, greater control usually comes with increased risk, especially if your choices aren't diversified and it takes more time to manage. Robo-advisors are automated platforms that manage your investments through algorithms. They're designed to align your personal financial goals and risk tolerance. Companies like Wealthsimple and Quest Wealth are 2 popular Canadian choices for robo-advisors. Now, on the plus side, robo-advisors are great for their convenience and simplicity. They're especially appealing if you're new to investing or if you prefer a hands-off approach. You can start off with a relatively small amount of money, which makes investing accessible to more people. However, there are some drawbacks to consider. While robo-advisors are programmed to follow market trends and make adjustments, they lack the personal touch and deeper understanding that a human advisor might offer, especially in complex financial situations. They operate based on algorithm, which means they might not fully capture unique investment opportunities or tailor strategies specifically for your changing financial circumstances. For those of you who find the idea of managing your own investments a bit overwhelming, or don't want to rely on an algorithm for your investments and want a personal touch, consider hiring a portfolio manager. Traditionally, this was an option only for the very wealthy, but now it's accessible to almost anyone. A professional manager can tailor your portfolio to specific needs and risk tolerance, optimizing your chances for success without the daily hassle. I've had great experiences with this approach recently and have partnered with some fantastic portfolio managers. In the past, I used to believe that everybody should learn how to invest on their own, but I've since realized in the last few years that many people really need help or don't have time to manage their own investments. If this sounds like you, this is an excellent option. Let's talk about a very important subject, and that is what to do with your TFSA once you retire and want to tap into it. The first question I want to answer that I get asked a lot is, should you withdraw your TFSA or RSP first? This is a common question and the answer isn't one size fits all, but let's break down the considerations. Withdrawing from your RSP first can be beneficial because it's taxable income. By drawing down your RSP earlier in retirement, you might be able to reduce your overall tax burden later on, especially if you could start receiving old age security, or OAS, which can be subject to clawbacks based on your income level. On the other hand, withdrawals from a TFSA are not taxable. This flexibility allows your investments to continue growing tax-free, providing a tax-efficient source of funds that doesn't impact your OAS. What is a good strategy for a $1 million TFSA in retirement? Well, with a substantial amount like that, you want to ensure it lasts and continues to grow. Consider using a bucket strategy. Divide your TFSA into portions for short, medium, and long-term needs. Short-term funds can be kept in safer investments, like bonds or GICs, to cover immediate expenses. Medium-term funds could be in balanced funds, and long-term can stay in equities to ensure growth against inflation over time. This way, you're setting up your funds to be available when needed, but they're still working for you. Finally, how should you manage your TFSA to work well with your CPP? A strategic approach is key here. Since CPP provides you with regular income, you could potentially use your TFSA to supplement these amounts during years when other income is lower. Also, consider delaying CPP withdrawals while at the same time drawing down from your TFSA if you retire early and need the money. This allows your government benefits to grow, which maximizes your income later in retirement. Hitting that $1 million TFSA goal might seem tough, but it's all about having a simple yet smart strategy and managing your risk and return properly. The harder part to me is to figure out the optimal tax strategy for your TFSA once you build it up. If you're wondering about the best time to withdraw from your TFSA or how to sync it with your CPP and RSP to cut taxes, or if you're unsure about your investment strategy or need tips on tax-efficient withdrawals, we're here to help. You can check out our financial planning services in the link below. We specialize in helping Canadians optimize their investments and manage taxes effectively. There's also a link to the written article for this video in case you want to refer back to it in the future. Don't forget to like and subscribe for more financial tips. If you got any questions, drop them in the comments. I'd love to help out.